that is set to report its first quarter earnings after today's closing bell. The analysts will be watching closely for updates on the company's margins and ad business. So we're talking all things Alphabet Google. We're bringing in our all-star panel, Doug Flynn, co-founder of Flynn Capital Management, and James Chalkmark, contributing editor at Techonomy Media. It is great to see you both. I'm so excited to talk about this. So let's start with you, James. You're feeling, what, optimistic on the numbers?
Yeah, I mean, basically, if you just look at the ad market right now, what's happening is the absolute size of it has peaked because the brands that are doing well are building direct relationships. And what's happening is the fact that it's moving toward digital because returns are all that matter. And when you think about returns, it's a duopoly that just cannot be stopped right now. It's a Facebook. We saw the results last week. And
right.
Google, because it's all about customer acquisition costs and getting the conversion and driving that lower. There's only two companies that can accomplish that. And then the direction and force of those trends just continues to allow Google to be in a dominant position.
Doug, what are you thinking? I mean, everybody loves FAANG. Everybody wants to be a part of FAANG. But at what point does FAANG, it's done or it's overdone? What are you thinking?
Well, I look at Google as 3% of the S&P in and of itself, and FAANG is 12%. So one out of every $8 in your S&P 500 index fund is already in FAANG. So
right.
you think about how much bigger can they, and obviously there are much bigger percentages within the NASDAQ 100. But I think that, as far as, I liked Google when it was below 1,000, a lot better
right.
than I like it now, which was only around the Christmas Eve lows. So I think that with the run-up that it has, it doesn't have as much upside from here before you get an additional catalyst, which you can get. They definitely have the bench to do that with some of the things they're investing in. But as far as the pricing goes with the run-up, it's up 30% from those lows just a couple months ago. That, to me, is always not the time to back up the truck and load up onto it as far as I look at it. You
were actually noting that it's been one that beats, right? It has a recent history of earnings beats.
Yes.
18% on average.
Correct.
So do you think that's possible this round?
I think that's by design. I think overall this entire earnings season, they've deliberately, everyone has lowered expectations so they can come in ahead. And Google absolutely, last year was outperformed by 27%, but on average it's about 18%. So whatever they're telling you, you pretty much have to set the bar about 18% higher. That's the real number to look at. Did they beat that? That would be what I would be looking for.
And what do you think? What's your rebuttal on that one?
I mean, look, they're growing earnings at 20%. The stock's trading around in the low 20s on an earnings basis. It's a discount to Facebook on a price-to-sales basis. It's not that expensive of a stock. And then when you strip out the other bets, which have optionality to them, it's a relatively attractive margin, approaching 30%. And when you think about catalysts, to your point, there is a crown jewel asset sitting there, which is YouTube. Ultimately, there is bound to be a disclosure there, just like you saw with AWS and Amazon. I think that a disclosure there, I mean, that's a company in and of itself that's worth easily north of $100 billion. And with the trends that's happening in media, they're going to continue to dominate.
And you also noted, James, that what shouldn't be overlooked, not only the crown jewel, but the company's investments in gaming and building out that infrastructure as well. Can you explain that?
Yeah, I mean, when you think about the purpose of media is to grab and hold consumer attention. Mm-hmm. Where is that attention going today? It's going toward gaming. I mean, gaming, the industry right now is a $135 billion industry and growing faster than the media market. If kids are spending more and more time on gaming and esports, they're building out this infrastructure to capitalize on that by through subscription gaming efforts. And if that attention shifts, the ad dollars, and all the the benefits that come along with that will follow.
So it's sitting at $12.85. I mean, it's had a nice run up, as you can see. I mean, what are you thinking? Where does this stock go in a year or 2 years?
Well, so for us, we're looking at it like fair value might be around just under 1,400. So, in and around here, it's on the higher end as far as, like I was saying before, about what you need to go to the next level. So I think it can get up to there. That's about somewhere between 3 to 9% from here is an easy hurdle. But to get to the next level, you need some of the things that James was talking about in terms of investing into the areas like cloud and other areas and the things that they have down the pike. But I look at things like they've got over $100 billion in cash. With the new U.S. tax laws where they could repatriate probably tens of billions of additional dollars of cash, to invest here.
I wonder if they'll do that.
I think they certainly plan to,
Good.
but that's a ton of money to invest. The problem isn't so much their earnings, the growth of earnings, and the amount of money they have. It's their spending and whether or not they can keep that in line, because they have spent a lot of money to stay on the cutting edge. And so that's some of the stuff we're looking at a little bit deeper.
Right.
When you're looking at the FAANG stocks in and of themselves, the upside from here doesn't seem as great to us as to some of the other ones, just because of the run-up that it's had. It's outpaced the market by 2 times.
At 1284 and change, where are you seeing it in the next year or 2 years?
More. I mean, I don't think you can stop this gravy train. I mean, unless that there is an emergent competitor that can provide better comfort to consumers on transparency, on privacy, and things of that nature.
Right.
You can't stop it absent some type of
20%
regulatory.
upside probably in the next few years. I mean,
I think it can continue to appreciate at the rate of earnings growth annually.
Interesting. All right.
Just to jump off. Oh, sorry.
Yeah, go ahead.
No,
One last thought in 10
the,
seconds.
From the lows of 2015, it's up 160%. So I just look at what percentage is it of your entire portfolio with the other stuff you own, and just invest accordingly.
Thank you both so much. Thanks to our panel, James Chalkmark, contributing editor at Techonomy Media, and Doug Flynn, co-founder of Flynn Zito Capital Management. Thank you both.